Ladies and gentlemen, good day and welcome to the Roundtable and webinar on India M&A Lessons from 2014 for Deal Making in 2015. This event is being organized by Nishith Desai Associates in association with our supporting partners IVCA, the Indian Private Equity and Venture Capital Association, and AIBI, Association of Investment Bankers of India. The speakers are Neeraj Karia, Associate Director from Kotak Investment Bank, Vaibhav Parekh, Partner M&A and Private Equity, Nishith Desai Associates, Nischal Joshipura, Partner M&A and Private Equity, Nishith Desai Associates, Simon Rees, Co-Head M&A and Private Equity, Nishith Desai Associates, Ankit Mishra, Member M&A and Private Equity, Nishith Desai Associates. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of today's discussion. If you should need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone telephone. Also, you can download our mobile applet, Nishith Mobile, which is available on the App Store for iOS device, Play Store for Android, and BlackBerry World to access the current update and videos. Please note that this conference is being recorded. I would now like to hand over the session to Ms. Simon Rees. Thank you, and over to you, ma'am.
Welcome all. We'd like to welcome our participants who have come to our offices, and our participants who have dialed in from Europe, New York, and London. Welcome. I'd like to begin this webinar today and roundtable conference by quoting from a famous American jurist, Justice Holmes, when he said, "The life of law has not been logic, it has been experience." This is true in deal making as well. In an ever-changing regulatory environment in India, we do learn from the past for the future. And it is in keeping in this that we have, today our first webinar of the year on M&A, Lessons from 2014 for Deal Making in 2015. We hope you will find this useful, and we invite you to participate actively. To briefly lay down the flow of the discussion today, in the first segment, we will reflect on our learnings on 2014, and in the second segment, we will then analyze what's in store for 2015. But before I move to our speakers, I think I would just like to delve on what we are at today. We're at a cusp of something quite exciting. After almost 3 decades, India has a majority government, and discourses are moving from socio-political to more economic reforms. This is also reflected in deal activity. In 2014, Indian companies have concluded almost 247 M&As in deals worth 16.17 billion. That's the highest since 2010, when 373 domestic deals worth 18.3 billion were reached. Indian companies across sectors are seeking expansion, are all on a great high. And not just Indian companies, but foreign companies entering into India as well. Just today, President Barack Obama announced a commitment of 4.1 billion USD to India. And this is perhaps the tip of the iceberg. If one were to go by industrial reports, 2015 could be a fantastic year. With M&A-friendly legislation, softening of some key regulations, which we will discuss later, there is room to believe that India could be the next global deal-making destination. This is reflected by the confidence of the CEOs, the key architects of decision-making. And if we were to go by anything as to what happened at the Davos meet recently, you will see that the Indian CEOs were the most confident amongst the lot. In fact, Finance Minister Arun Jaitley's, the conference where he was supposed to speak was in fact, the room had to be changed for to increase the number of participants wanting to actually attend his conference, which is a stark contrast to last year, where you had to actually downsize the room. So with this, I think let's start with the first segment. Neeraj, my first question would be to you. How would you look back at the M&A market in 2014? What has been your experience in terms of sectors, in terms of deals? What has been your experience in 2014?
So, if you look at, so Simon, I do agree with you that the flurry of activity has definitely increased. Is it that far and wide? I'm not really sure of that. The number of deals in 2014 versus 2013 versus 2014 have definitely jumped by at least 30%, while the value has jumped even higher. I think I have different numbers, but there are always sources. So in my view, the numbers have increased from somewhere around 20 to 40 billion for all private capital coming into India, whether M&A or private equity. I think out of the 40 billion, somewhere around 10, 12 billion is private equity money. So the increase in activity has also seen increase in deal sizes. And there are pockets in which deals are happening. It's not across the board as we used to see earlier. But so if you take some examples of where the deals are more prevalent, on the inbound side, you're seeing lots of money coming in from Japan. You're seeing more and more money coming into businesses which have high cash flow. So consumer, pharma, tech, these are sectors which are seeing more and more activity. Now, if you were to pull up the same chart from 2005 to say 2009, I don't have that chart, but when we used to do those charts at that time, telecom, energy, and pharma used to make up probably 70% of the activity in terms of value. Not in terms of number, but at least in terms of value. Today, that split is very different. Today, that split is more driven by, as I said, by businesses which have high cash flow. So tech, pharma, consumer, and e-commerce, I think these are the sectors which are seeing more and more level of activity. If you see even on the outbound side, it is the same. It is consumer. I think Imami announced something a few days back. Ranbaxy Pharma is one example. If you see SoftBank's investment, at one shot they did 2 investments in India. They just committed $900 million of capital in a period of 1 week to India. 80% of that going to 2 deals, right? You have Snapdeal and you have Ola. So such kind of deals, in my view, will continue even in 2015. If you see the other 2 or 3 trends, what happened in 2014 and what used to happen earlier, larger companies and market leaders have done deals. So if you see people like Ranbaxy, right? Snapdeal is another example, but if you take larger companies like Ranbaxy and let's say in the tech sector, there are larger deals happening. So yeah, Flipkart being one of them. So there are larger companies are trading. Well, those kind of deals you did not see in 2007, 6 or even till 2011, right? You saw them only recently. Those were actually consolidators. Now actually those businesses are getting traded. The second large theme that we are seeing is domestic consolidation. So Flipkart Mitra is one. Ranbaxy Sun is one. Aditya Birla Pantaloon is third. So there are various such deals which are now being more and more prevalent. Now we've got to see how many of those will actually be successful and if Indian companies will run away from buying more and more Indian companies. But I think that is a trend that is catching up. Kotak ING is one more large example. So that Indian companies, if you see their revenue base in 2005 versus 2014, if you look at the top 5 corporates, anywhere from 40 to 60% of the revenue comes from outside India. And they have already become, for choice of better words, Indian multinationals, right? So if you have such large exposure out of India, some of them have burnt their fingers outside India. And they've realized that it is time also to consolidate in the Indian market. So this theme, and also, in my view, we've seen it and will also continue. E-buyouts. I think that is the one thing which is clearly coming out. If you look at the data last year, probably 10% of the deals were buyout deals. If you look at in the current year, right, the only deal that has been announced in January 2015, right, is the Agile Blackstone deal, right? So there are this theme again. So when you saw Putney, iGate, and such deals last year, they were also buyouts. So they were consolidation, but they were also buyouts. So this theme also I think is becoming more and more prevalent. So in a nutshell, I think deals are getting bigger last year. Domestic consolidation is a theme. Pockets of money, pockets of businesses are finding money. It's not far and wide as yet.
Thanks, Neeraj. I think all of this speaks well of the Indian economy, and the India story is definitely selling.
Yeah.
Large deals, consolidation is nothing but an evidence of that. I mean, you dealt upon Sun Pharma, you dealt upon, I'm sure you've done the Arch, and talked about Japan.
Yeah.
Any key learnings that you wanted to stress on in 2014, because these deals have a mixed emotion attached to them as well?
Yeah, you're right. Sun Pharma is actually not a great example for for the Japanese, and nor is Docomo. So, but that has not stopped Japanese money to come into India. We are still seeing that is the only country where we are seeing far and wide interest from, and it is across sectors, whether it is real sector of manufacturing, whether it is IT, whether it is e-commerce, whether it is pharma, whether it is consumer. Right, it's all across the board. Mitsui actually did a very interesting deal with Goldman Sachs last year. Most of you all would have read about it. They did a JV with Mahindran, effectively. So it's a three-way JV. Yeah, so it's a three-way JV between Mahindran, Goldman Sachs, and Mitsui. And it may look like a financial JV, but it is somewhat like backing an entrepreneur. And from what I understand from Goldman, they're also going to use some of the Asian Mitsui brands to leverage in the Indian market. So Japanese, in my view, are getting very creative in India. That we never used to. We used to see very, very simple deals till 5 years back. Now they are starting to flex their muscles in India.
We can proudly say we were part of that creativity. Moving on to that, I think my next question would be to you, Weber. Neeraj talked about deals. We talked about the mixed emotion. I think very important is the level of due diligence that needs to be done. What kind of due diligence needs to be done? What are your learnings from 2014?
Thank you, Simon. Welcome everybody, and welcome from Bengaluru. I think people who are there may be able to see me. Let me expound to what Neeraj said. Right, he said that deals are going to get bigger. Bigger the deals, more riskier it is. Right, and what we have seen in 2014. And if you do analysis of all the deals which have failed or gone sour, and you find out on what went wrong, invariably one thing will jump out that, hey, we could have done a better diligence. That's what the companies who did the deal would say if you ask them now. Shareholder activism, LPs are now becoming more and more vigilant. Shareholders and LPs are saying that, look, we can take a business risk, but we do not want to take a risk where you do not do your due diligence properly. We do not want to take legal risk. We do not want to take due diligence risk. That is the message which is coming across, because what we are seeing is not only the company is or the fund is losing out on that particular transaction which has gone sour. In some cases, we are seeing the LPs or the shareholders questioning and suing the company for not meeting their fiduciary duty. So it is becoming like a double whammy for companies where the diligence is not done well. There have been live examples which we see, which for sake of confidentiality, I will not be able to take the name, but there have been cases which has been put on in the US courts also, where the investors are suing the company for not doing diligence well. So I think that risk has become real in 2014. Secondly, if you see, examples we just discussed, not a great example for Japanese, the Daiichi Ranback CTL. If you see where and why Daiichi lost a lot of value, I think it comes to contemplate on did they do the diligence well, and were they able to appreciate the legal risk well enough for them to give the value what they gave at that point in time. Often when you see the result of the Sun Apollo deal, you will, I'm sure people will say that, had they looked at the risk carefully, maybe they would have done a better job in doing the deal, original deal. Similarly, when you look at diligence, you are just not looking at diligence from what the documents you get from the other side, because often diligence is treated as a check mark. Oh, I did the diligence tick mark, because often company talks to the other side, whether the acquirer talks to the query company or a fund talks to the target, and they get comfortable with what they see. They get comfortable with the opportunity there. So often risk associated kind of get sidelined, and what we see is that when the document is given to them by the other side, they will look at a document and say, you know what, here, tick, the deal is, the checklist is done, we have done the diligence, we can now close the transaction and be happy, ever after. But unfortunately, that's not reality what we saw in 2014. Most of our litigation practice, which we have, and we check with them, we work with them closely, and we find that most of the disputes could have been avoided if the acquirer or the fund would have done diligence in just a lot more detail or in again, diligence is not just legal diligence, but also whether it's a cultural diligence. There are various ways to go and look at the same thing in a different way to catch if there is any underlying larger issues. Whether you look at background checks for promoter, whether you look at maybe sometimes in a listed entity or in some other entity where RTI is available, MCA website, sometimes forensic evidence to be used to check if there are certain things you need to go down in detail. So various ways you look at it to determine what risk exists in the transaction before you close the transaction, because the cost will be too high. And same thing goes from culture and label perspective. Often we miss out the softer aspect and just look at the numbers, but recently we have seen several situations where the merger itself has caused labor problem, and people did not think through on how well the labor will react, or people will react, or how well the culture will fit in to really make the integration smoother. So all those diligence point is important, and each one which I discussed, we have seen issues in 2014.
Thanks, Weber, for that. Neeraj, I think on a related note, we've talked about legal diligence, Weber talked about cultural diligence, he's talked about forensic promoter diligence. From a banker's perspective, in terms of the commercial diligence that you do, you can give us some insight into that. Especially, we've talked about these large deals in listed transactions. The regulations have just changed to give us some sort of leeway to do more thorough diligence for a listed company. I just want to get your perspective from a 2014, from a business and commercial diligence perspective.
Okay, so I think the trend, Vaibhav, that you mentioned on legal diligence also stands true for commercial diligence. I think companies are being tested, or targets are being tested even deeper as time goes along. In 2007, as bankers, we've done a deal in Thomas Cook where we said there is no diligence, zero diligence. You give a price based on zero diligence. Such kind of deals are very difficult to do today. Buyers are wanting to talk to customers before they enter into the target. You can always decide the timing of when you can do it, whether it's done after signing, whether it's done very close to signing. We should try and restrict all this probably in 2007, 2008, 2009. But today, I think these things are becoming more and more prevalent. Second thing, as you mentioned, Vaibhav, also I agree, promoter checks leading to various things. People talk to banks, people talk to friends. So And there are always, between buyers and sellers, there are always one or two links within the social circle that people can talk to. People always used to do it, but I think it's becoming more and more prevalent and more visible. Books, in my view, to be honest, I think on the financial side, I haven't seen substantial issues coming out from financial diligence in the last probably 2 or 3 years. I don't know if it's the kind of people we work with or what, but it's we haven't seen, because I think if you see companies which are anywhere above 100 million, let's say $150 million or $200 million in turnover, they would typically have a good auditor.
So the Satyam story has taught everyone a good lesson.
Yes. So I think even from a target perspective, books, I don't think we've seen too many issues. One very interesting theme that we've noted this year is something which was always a risk earlier, but we've not seen it as a reality till now, is the exchange risk. So for businesses which have anywhere from 30% and above coming from export in terms of revenue, so we were running this one deal, which in the beginning of the year, the dollar was somewhere, and we reached 67 in the middle of the year. And the whole model is based on 56, 57, and then you in the middle of the year you start showing inflated or higher. Let me not use the word inflated, but at least let me use the word higher margins. So where does the sustainability lie for those margins? Will the revenue sustain at that level, and who's actually going to take the risk? Because that is something that is even external to the buyer. As a seller, you can have all kind of arguments around it, that it needs to get priced in. But as a buyer, he's not really willing to take that risk. What is the midpoint you find within that is only dependent on how how the buyer and the seller are comfortable, how the businesses perform. What is the impact of all this? Effectively, the impact of all this, in my view, is that the deal cycle becomes longer. Because you want to wait one more quarter before you see the actual numbers come out. So, hence, whatever you are seeing in terms of uncertainty, this is an additional peg which is added to that uncertainty in deals and has elongated deal cycles. Not to touch upon legal things, but I think we are seeing more and more discussion and complexity and innovative structuring on exit clauses. I think they used to be simpler earlier. They used to get negotiated with 1 or 2 layers and it used to get done. But today, I think you build in typically 4 or 5 or 6 layers, either from the buyer side, seller side, and the exit clauses are becoming much more longer and much more complex. I think from a deal perspective, just going beyond diligence also, this is one thing that takes, in my view, in terms of the whole deal making, it takes is added at least 6 to 8 weeks in terms of the deal.
So Neeraj, thanks for that eye-opener on business diligence, but you've led us nicely into the next question that we wanted to have a discussion on, in terms of, innovative structuring. In addition to exit clauses, I think, Mr. we've seen, I think Neeraj mentioned the Thomas Cook transaction, we've seen the Jet Etihad issues in terms of, some legal structuring. Maybe you can delve on, the new and innovative structures that happened last year.
Sure. So I will talk about few structures on public M&A side and few structures on the private M&A side. I think on the public M&A side, what we saw last year was the stock swap through a merger route was used a lot, especially for the largest deals like Sun's acquisition of Ranbaxy and Kotak's acquisition of ING, where a merger route was used. And the reason for this has been because any transaction which is structured as a merger has multiple benefits. One, it is exempt from open offer obligation under takeover code. So the acquirer does not have to make an offer to the public shareholders. Second, merger is also a tax exempt transaction from an income tax perspective. So you don't have to shell out additional taxes to the government if you are structuring your transaction as a merger. And third is, from an acquirer's perspective, you don't have to shell out cash to the shareholders of the target company. You are just giving your currency, which is a liquid security, which the shareholders of the target are usually comfortable with. So this is one thing which we saw in 2014, where stock swaps have started being used as a currency for acquisitions, which is something which also happens a lot in developed markets. So right now they have been used more for domestic acquisitions where the acquirer and target both are domestic. But if the regulations are liberalized, maybe with the Modi regime, we might see the stock swaps happening even with the foreign acquirers, and the government and regulators also softening the stand on various issues. So this is something which we saw was quite interesting in 2014. Another interesting structure which we saw in 2014 was Thomas Cook's acquisition of Sterling Holidays. This was one structure which pretty much had all types of share acquisitions and almost all types of asset acquisitions built into this structure. So it started with a share purchase agreement with the promoters. So there was a negotiated share purchase, followed by a preferential allotment by Sterling Holidays, followed by market purchases through block and bulk deals, followed by an open offer, followed by a demerger of the timeshare business of Sterling Holidays into one of the unlisted subsidiaries of Thomas Cook, followed by a merger of Sterling Holidays with Thomas Cook. So very interesting transaction. They could have just done with merger and demerger, but the problem there was that for a merger to go through from a shareholder's perspective, you need at least 3/4 of the shareholders in values approval. And to achieve that, they had to do all this transaction of negotiated share purchase, open offer, pref allotment, to at least reach some stage, maybe, and they managed to reach about 55% at the end of the first 3 or 4 steps. So when, at the time when the scheme of merger demerger comes for approval, they pretty much have majority shareholding as far as members present and voting is concerned. So this was quite an innovative transaction in 2014. Another transaction which is currently going on is the SpiceJet one, right? Where Ajay Singh is buying SpiceJet from Marantz, and there is a change in control which is happening. Now, typically a change in control triggers open offer under the takeover code. Again, there is one innovation which is being used, and again we'll see whether SEBI is comfortable with that or not. But typically we have seen that schemes of merger are exempt from open offer obligation. But the same exemption also covers a scheme of reconstruction which has been sanctioned by a competent authority. Now SpiceJet recently got the scheme of reconstruction approved by Ministry of Civil Aviation. So one of the views which SpiceJet is taking or will take is that there is no need for an open offer, because scheme of reconstruction sanctioned by Ministry of Civil Aviation falls under the exemptions from making an open offer under the takeover code. Now, this is very important, especially in distressed acquisition, right? You don't want any leakage as far as the acquisition consideration is concerned, because you want all the money to go into the company rather than to the public shareholders to take the company out of distress. So this is one exemption which I think is quite a unique exemption which will be tested with SEBI. I don't think any other company has gone through the scheme of reconstruction for the purpose of avoiding the open offer. So that's another interesting transaction which we saw. Couple of other transactions or structures on the listed side that we saw was a lot of promoter funding transactions where private equity funds funded the holding companies of the promoters through listed NCD route or listed non-convertible debenture route, and that was used for making creeping acquisitions in the listed company by the promoter. So that was again an innovative structure where there are ways in which you can avoid the persons acting in concert risk for the promoters along with the private equity funds. One more type of transaction which we saw on the public M&A side was because the acquirers are facing challenges in, first of all, acquiring the Indian company, then delisting, and then squeezing out the minority shareholders. One of the easier ways which the acquirers have started preferring is to just do a business transfer or slump sale of the main business from the listed company to one of their Indian subsidiaries. And this is something which is becoming quite convenient for the acquirers, because they don't have to go through the pain of meeting with the regulatory thresholds of delisting, and if delisting is not successful, you have to bring the shareholding back to 75%, followed by a squeeze out, which again the law is still developing in India. We have cases of selective capital reduction, but still it's not something which which is a clear-cut case, and there could be prolonged litigation on that. So broadly, these have been the structures on the public M&A side. On the private M&A side, what we have seen is a lot of technology e-commerce companies are flipping the holding structure from India to outside India, primarily because of many reasons, like private equity investors are more comfortable investing in foreign companies with Indian businesses rather than Indian company with an Indian business. One is the flexibility of listing. It's easy to get a higher valuation for a foreign company as compared to an Indian company, especially when you are in a tech or e-commerce space and you're looking at listing your stock on NASDAQ. Second advantage is the enforceability of your contracts is much better in foreign jurisdictions as compared to what you have in India. Third is the exchange fluctuation. You are investing in dollar and you are exiting in dollar. So the money which was lost by a lot of private equity funds from 2006 to 2009, when they invested, the dollar was 42, and at the end of their fund life, the dollar is 62. So a lot of these guys, even though their portfolio companies made IRR, but when it came to dollar returns, they made losses. So a lot of them have realized that it is important to invest in a foreign company but with Indian businesses. Another thing that we also saw to bridge the valuation gap between the acquirers and the sellers, earn-out structures were used a lot, which means that to the extent of meeting with the immediate cash needs of the sellers, upfront payment was made, and for the balance amount where there was a valuation gap between the sellers and the acquirers, earn-out mechanism was worked out depending on the EBITDA of the target company for the next 2-3 years. However, a word of caution on that, what we have also seen in that while earn-out works well at the time of bridging the valuation gap, at the same time we have also seen disputes happening because of what is the actual EBITDA in the next 2-3 years, and that's something which the acquirer should keep in mind, that whether you want a deal certainty on day one or you want to bridge the valuation gap and ensure that there is smooth transition with the promoters being on the board for the next 2-3 years. Last but not the least, what we also saw in terms of structuring was the emergence of the reps and warranties insurance, especially for private equity backed companies when they were selling their stake. And I think as Neeraj mentioned about the Blackstone agile type of transaction, where a PE fund is completely controlling the portfolio company or is a majority shareholder in the portfolio company and it is exiting, the buyer would want certainty on who is going to pay the indemnity and who is going to give reps and warranties. Now, typically a PE fund is a limited life fund, and when you are exiting, you are typically approaching the end of your fund life. So how do you give comfort to the buyer or the acquirer that if there is any claim for indemnity, you will be able to honor that claim? That's where, as a middle ground, what we have seen is reps and warranties insurance being used a lot, at least in few deals. We used it in 2014, and it worked out quite well both for the acquirer and the seller. So even if the fund life of even if the fund is wound up or the seller is wound up at a later date, if there is any indemnity claim, the insurance company will make good that indemnity claim. The buyer and the seller share the premium cost. So, or it could be the seller only bearing the premium cost depending on the negotiation. So broadly, these were the structures that we saw on public and private M&A side in 2014.
Thanks, Nishith, for that. I think the discussion stemmed on e-commerce, stemmed on being one of the large sector that attracted investment. Vaibhav, I think I will pose my next question to you in terms of, we've seen that regulators today are viewed a little bit with mixed emotion in India. Maybe I will draw on your experience to discuss the regulatory hurdles that were faced in 2014, especially in these kind of ways.
Thank you, Seema. There was, if you ask me on regulatory side, we can talk for days, but I will just focus on key aspects which we saw in 2014. One, e-commerce, we have seen that there have been a lot of sensitivity from FDI perspective. Question really was that all these e-commerce trading companies Are they violating any FDI? Two things emerged in 2014. While there was no conclusion on ED whether they've done the investigation and identified whether there is a violation or not, but what is becoming clearer is that government is accepting marketplace is a FDA compliant business model. And for the first time, we have seen government has actually given, FIVB has actually given approval for a marketplace model, which means that if you are in a marketplace model, you will be FDA compliant no matter what the news or noise in the market. And that's one reason why you are seeing a lot of companies are going back to marketplace model from as opposed to two-company model that they originally had. Secondly, what we have seen that government is also scrutinizing very carefully the payment flows in those kind of companies to determine whether it's a marketplace or it is something else in guise of a marketplace. So they are looking at how the payment is flowing, who is controlling the money, is the marketplace controlling the transaction between the buyer and the seller, or basically they are acting as a role of being a marketplace and being a platform for buyer and seller to meet. So it is simply not that government is looking and saying marketplace is fine. They are actually trying to draw a line to say that if you are a marketplace, then you behave like a marketplace, and as long as broadly you are in this counter, you should be fine. And that's where we are seeing on e-commerce trading as a kind of a certainty which we saw in 2014. Second kind of issues we saw on e-commerce and on technology side dealt with payment and payment gateways. We saw in a situation of Uber where Reserve Bank of India clarified and passed a regulation saying that look, if you are basically an aggregator and you are connecting a buyer and a service provider in India, and if the payment is made through credit card, then you will need to go through the two-level authentication system. And basically, that just for the one point. The other point also is that if the service provider and the service taker, which is the customer, is in India, you really can't pay in foreign exchange. You have to pay in rupees. That's a fundamental law. Now, what it means is Uber typically falls into that category, and it was explicitly for that particular incident which happened. But people have not realized that the implication is far-reaching. All aggregators, whether it is Booking.com, whether it is iTunes, whether it is Google Play, or any aggregator which aggregates under the new regulation, have to segregate Indian service provider, and when they are basically selling the Indian service providers to Indian customers, they will need to go and meet that particular regulation, which means they will need to do dual authentication, and they will need to make sure that the money is paid in rupees rather than in dollars. Now, this is something which is to some extent will affect e-commerce. Secondly, if you look at from regulation perspective, payment side, Bitcoin became very popular in news in 2014. A lot of regulators, not just in India but world over, do not know how to regulate Bitcoins. Two things have emerged clear. One, our discussion with Reserve Bank of India, as well as our own analysis in which we have also made a very public statement by our founder partner. One, we believe Bitcoins are legal and not something which are illegal, and hence a lot of raids which were happening on Bitcoin providers were consequently stopped because of the statement what our founder partner made in 2014. Our discussion with RBI also believes that RBI is not going towards banning Bitcoins and is not considering Bitcoins to be illegal. So Bitcoin as a payment mechanism has a very interesting future. It has the ability to regularize payment systems. It has the ability to reduce the transaction cost down to very, very minimal level, and that can be a very innovative mechanism for online commerce. But on the other side, the risk is also sufficiently high, and the speculative aspect of it is something which Reserve Bank of India is definitely going to control. So while Bitcoin is fine or legal as of today, and we don't believe that Bitcoin will become illegal later on, which means that RBI is not likely to ban Bitcoins, but RBI may restrict or come out heavily against speculative aspect or speculative business of Bitcoin or illegal use of Bitcoins from money laundering and drug perspective. Secondly, we are seeing situations where law has kind of not kept up with technology. We just discussed about aggregators in terms of Uber, in terms of payment, but also aggregators like Uber face a lot of other issues, whether it amounts to whether you have tourist vehicle which can work as a radio cab, or can you be an aggregator in a radio cab and not have your own cars? Is it something which is legal? Or for example, there is another aggregator which allows people to go and book for let's say ride a car, a private car, like take a lift on somebody's car, do carpooling, but pay for that. The questions have always come in saying that is there something which is legally permitted, and whether the regulations are flexible enough to permit this kind of new business model. So basically, new business models kind of fall foul of some of the laws which originally were not anticipated. And originally, when they were made, they did not anticipate this new business model. The biggest case in point is, let's say, Amazon. When Karnataka went against Amazon and they said, we will not allow you to basically stock all these vendors which you have in your warehouses, because basically the place where you are stocking the goods for in your warehouse is a place of doing business for the vendor. And if 100 or 300 vendor in Amazon's case is going to ask for having the same address to be registered as a place of doing business, then that is something which you will not permit. Or recently, I think yesterday it came in news that state of Kerala has fined e-commerce company to the tune of 54 crores, with Flipkart taking hit of 47 crores on non-payment of sales tax. Why? Because they don't have brick and mortar in Kerala, and if they don't have brick and mortar in Kerala, they are not required to pay sales tax. But what state government of Kerala is doing is saying that the website we will treat as brick and mortar, and we will tax it as if the website was, because they are with access from Kerala, we will tax it as if the business has a brick and mortar office in Kerala. So you are seeing issues like this becoming real, and hopefully GST will take care of all these indirect tax issues which we see in e-commerce. But this is making life difficult from e-commerce perspective. On one other point, going a little bit away from e-commerce, on FEMA issues, what we have seen in one situation, basically Nishith discussed about earnout becoming popular. We have seen in 2014 that Reserve Bank of India is taking a very positive outlook for permitting both earnout, escrow for more than 6 months period, and also permitting escrow for indemnity for longer period of time, including up to 8 years. Now this is something which is one of the first we saw in the unit we saw in 2014.
Thanks, Webunar. I think you summarized some of the key regulatory issues, the hurdles that we faced in 2014 really well. I think the last question for this part of the session would be to Ankit. M&A is a function of corporate confidence, and decisions can't be made unless the boards take are allowed to make decisions or can take proper discussions or proper decisions, and also shareholders have a big role to play. I think this year or last year emerged as one of the key years for shareholder activism. In fact, per a report, BNP Paribas Asia report, it said that in India was the highest incidence of shareholder activism in Asia. So maybe you can give your thoughts on shareholder activism, its importance, and wrap up session 1 in 2014.
Yeah, I think Simon, you referred to the report of BNP Paribas, which says that India has possibly seen the highest level of shareholder activism in Asia. Now, these levels are very low compared to developed jurisdictions, but you cannot compare the level of shareholder activism in developed jurisdictions to that what is there in India, simply because the capital structures are different. In Asian economies, you have more controlling shareholders, and as a result of which you're not likely to see a lot of shareholder activism. Shareholder activism thrives in economies and in corporates which have a more dispersed sort of shareholding, where shareholders are able to sort of voice their opinion. Now, I think what was different about 2014, this is not the first time in 2014 that we saw shareholder activism. The most famous one goes way back in 2008, with Satyam and Mehta's deal was blocked by extreme pressure that was put by shareholders, and that deal was blocked. What is different about 2014, and that's the sort of excitement that at least the proxy advisory firms are getting, is that there is, in fact, for the first time in 2014, we have seen sustained shareholder activism over a period of time. There have been isolated cases, but a sustained shareholder activism has not happened prior to 2014. Now, before we go into what is the lesson for some of the deal makers and how to sort of calibrate risks arising out of shareholder activism, it is important to understand where we are today in terms of the nature of activism that we have seen. Let's take four, five big examples. The first case is TCI trying to exert pressure on Coal India, because Coal India was selling coal or guaranteeing coal to private parties at prices which were below the market price. Then there was activism by Ambuja's shareholders, because there was a increased royalty payment being made to its parent Holcim. The other issue we saw, and this is more relevant in the context of M&A, is Alstom shareholders actually questioning the board for selling one of their transport divisions at a valuation which was cheaper than what ought to have been the valuation according to the shareholders. We have seen these shareholders of Tata Motors vote down an executive compensation. We have also seen the shareholders of Maruti Suzuki putting extreme pressure on Maruti not to buy cars from a plant that was being built by Suzuki when you had cash in your balance sheet to sort of build a similar plant. And lastly, and this is more relevant in the context of M&A again, is the sustained shareholder activism we have seen by the United Spirits shareholders against Diageo. One of the key elements of that deal was Diageo's ability to integrate its India business through distribution and licensing arrangements, which use United Spirits distribution network and sort of spread the Diageo brand. And that is one of the key elements of that deal. Now, that arrangement was voted down by the shareholders. Now, if you see, what emerges from all these cases is essentially that the shareholder activism is limited today to traditional corporate governance issues. We are not seeing shareholder activism in areas which creates more shareholder value. For example, we are not seeing a sustained campaign for asking companies to declare dividends or for buybacks or to cause divestment of their non-core assets. Though in the last few years we have seen extensive divestment of non-core assets, but that has not been fostered due to shareholder activism. It is something that boards have done on their own discretion. The other aspect is that most of these activism is coming from institutional shareholders and not from retail shareholders, which is distorting the picture, because, for example, the USL Diageo, there could be two views about it, but at the end of the day, it was voted down not because the proposal was perhaps bad for the company. It was voted down because a lot of retail shareholders did not participate, and as a result of which one block of institutional shareholder had a larger say. Now,
that is distorting the entire picture. So we're seeing more institutional shareholder activism, but less retail shareholder activism. The other trend that emerges is that most of the shareholder activism has not gone to its logical conclusion. For example, the shareholder activism today is limited to pressurizing boards, but not essentially taking the promoters to court. We have not seen shareholders take promoters to court yet, and this is something that may change with the kind of dispute resolution mechanism, including NCLT, etc., that is coming up. Shareholders may have more belief in the judicial system to actually approach the courts and get a resolution quickly. Now, coming to the question of whether these levels of shareholder activism will sustain, I think the answer lies in what are the underlying factors for the shareholder activism. The underlying factors is A, the promoter shareholding is consistently been falling down for half a decade now, and this is going to continue given the corporate balance sheets that we have, the high level of debt, promoters are pledging their shares, etc. This will sustain. Second is minority shareholders have gotten empowered with the kind of laws that exist today, with the corporate governance code that has come in, changes to clause 49 in the listing agreement and the Companies Act. They have got empowered to sort of go and challenge the board because they feel they have the legal backing to do so. And thirdly, I think the growth of proxy advisory firms which are consistently sort of putting out there how shareholders should vote is giving more power in the hands of the minority shareholders. Now, the answer is simple to the question you posed, what we foresee in the coming future. Whether shareholder activism is good or bad, I don't know. And this perhaps may not be the right forum to discuss it. But whether it will sustain and whether deal makers will have to be conscious of that, the answer is a clear yes.
Thanks, Ankit, for...
Just to add, in fact, comparing apples with apples, so as you mentioned, in US, the shareholder activism is much more intense as compared to in India. The classic example is Carl Icahn. He is the largest or the biggest shareholder activist in the world. He actually pushed Apple to declare dividends, and Apple actually declared about $42 billion of dividend in the first half of 2013 because of the pressure of Carl Icahn, in spite of having a solid board. Take a similar example in India. You must have read this news item that 3 of the Infosys founders, they actually wrote to the Infosys board that you should declare at least 40% of your profits of Infosys as dividends, and nothing happened, right? So clearly there is a long way to go for Indian shareholder activism to move towards what the developed jurisdictions have today. But at least in US, there are shareholder activist funds which are being raised. So there are a lot of LPs who want to invest in GPs who are shareholder activists, and their theme of investing is to take the target company or the portfolio company to ransom and make them change their strategies if they are not acting in the best interest of shareholders. So this is, I think India will still take a decade to reach that point, but at least we have started seeing some of these things happen.
So Nischal, Infosys may have not heard, but I think some of the regulators have been discussing dividend policies. So this will definitely go a long way in terms of how this is seen. Sorry, Neeraj, you had a point to make.
So, while this is a legal topic, but let me try and put some reality and commercial view on this, as we see it. And you can see how interesting this topic is because everybody wants to comment on it. So, I think philosophically, the problem in India versus the West is, or developed market, let me not say West, but developed market is that Indian companies are promoter driven, right? And there is an inherent mistrust from investors that the promoter will always do something which is in his interest versus the company's interest. And in India, there is an added complication that the promoter is also the manager of the company. He's not only the largest shareholder, but he's also the manager of the company. So this structure itself lends itself for debate. Okay, and hence I think what the government has done is the right thing. Eventually, it has to move to good corporate governance, and this is the one way of doing it. But if you flip it around, and given that this is completely new and untested for India, and it is just hit the Indian corporates. Indian corporates are used to getting shareholder resolutions passed in a certain way. And this is just hitting them. And you're seeing more and more large corporates. And the larger the corporate, the more you're facing it. That is the trend. Smaller corporates, I know there are some mid-sized corporates who even got resolutions for paying certain amounts and royalties in the names of family members without problems, without any kind of shareholder activism over the last 1 year. So even those kind of cases have gone through. But if you see larger corporates, they have faced more activism. Now, whether it is, I'm not saying it is justified or unjustified, but to some extent, some of these cases are extreme. Okay, and I'll take one example. And we've been involved with some of them, and more and more for us, we also try and help corporates engage with investors on this. The other flip point of that is that you're actually not supposed to engage with investors on this. So how does a corporate actually get it passed? So there is also a legal debate going on as to whether you should be talking to retail shareholders. How do you get retail shareholders in? Because if there is somebody who's marketing for you, are you actually influencing the retail shareholders to vote in your favor? That is also a question that corporates ask us, that whether you're allowed to do this. Okay, so let me take this one example of Tata Motors. Okay, it's a very interesting case. There were 4 or 5 resolutions that were put to vote last year, and there were a few relating to managerial compensation. Then there were also a few more which were more operating in nature. One of them was very interesting. It was just about creating an FD. Okay, and so there was a lot of activism around all kind of resolutions, and there was so much mistrust, and they said, we're not going to pay you this. None of these resolutions should be passed. Now, Tata's had, if you break down that resolution into 3 parts, there was resolution with respect to the manager who expired during the year is passed. There was for people continuing in the future, put that in context with the losses that Tata Motors is making, and then there were other operating resolutions. So last year when they went for the resolution, everything was rejected. This year when they went, I think at least part of it has got accepted. And I think Tatas have also handled it very well, explained it very well. But, as you rightly put it, proxy firms, who are these proxy firms? And I've met some of them. Somebody sitting in Hong Kong, somebody sitting in London, and somebody sitting in Singapore. Do they really understand India? Is a question. I think that is still not answered. There was this very simple resolution about FDs. Okay, and probably most of you know, but just to go back to why these proxy firms are important, is because under the charter of the FIIs and now even for domestic funds, they have to take into account what a proxy firm says, and it is recorded. So if they have to vote against what a proxy firm says, it is very difficult. And I have seen that happening. It is not that they don't do it, but it is very difficult. So in this case also, all the proxy firms again said no for Tata Motors resolution, but they passed it. Shareholders have passed it. So let's take this FD example. The Indian proxy firms all said that this is fine, there is no problem. The foreign proxy firms actually said that this is not fine. And why? Because in Brazil, somebody has faced a case where that bank went bust and they lost the money. Now, if an Indian company is putting money in HDFC or such a bank, if you're putting in some cooperative bank, you can challenge it, but you can put restrictions around it. But if you're putting money in an FD in India, in a fairly sovereign or a fairly stable bank, should that resolution actually be rejected? So I think, and then you also talked about this Maruti case, right? If you look at that, you have to go and get 75% of the shareholders to vote in your favor. And I understand, I think some discussion is being done around, making that 50%. But just look at the life of the corporate. It is becoming more and more difficult. I'm not saying this is a good rule, but it will take such amount of time for this to get tested and settled. Until that time, how much time is the board and the IR team spending just on these smaller and trivial issues?
I think we will have to.
I think 5 years down the line, we'll need laws on protection of majority shareholders.